So after a pretty calm stretch, the markets have suddenly hit some serious turbulence. We've seen some sharp drops, you've probably felt it, and it's got everybody asking one big question. Is this it? Is this the start of a real correction, a fundamental change in direction for the markets? Or is it something else? In this breakdown, we're going to dig into the evidence and figure out what is really going on here. All right, so let's just cut to the chase. What's our take? Well, we think this is most likely just noise. We believe all this recent volatility is really just the result of a temporary kind of mechanical glitch in the market's plumbing, not a sign that the big overall trend has actually changed. And I'm going to show you exactly why.
Okay, first things first. We have to understand the mechanics behind this sudden spike in volatility. This wasn't driven by some huge economic news, but by something a lot more, well, predictable. It's an event that happens every single month on the market calendar.
It all boils down to this thing called monthly options expiration. Now, to put it simply, you've got these huge market dealers who are constantly making bets to protect themselves. It's called hedging. And this forces them to be a stabilizing force, right? They buy when the market dips, they sell when it rallies. You can almost think of them as a safety net for the market. But here's the catch. When these options expire, that safety net gets yanked away, just for a little while. This slide right here is the perfect way to picture it. Think about bowling. A normal market is like bowling with the bumpers on. The dealers are those bumpers. They're the shock absorbers keeping your ball out of the gutter. But after options expiration, poof, the bumpers are gone. And suddenly there's way less liquidity to absorb any shocks. So any little piece of negative news can send the price dropping, and fast, until it finally finds a solid group of buyers way down the lane. Okay, so that whole low liquidity theory sounds pretty good, but does the evidence from what actually happened in the market support it? Let's take a quick spin through the major assets to see if the price action actually fits our story. Let's start with the big one, the S&P 500. We definitely saw a break of a key short-term support level. Looked pretty scary, I'll admit, but look closely at where that drop stopped. It was right at the lower trend line of its long-term channel. It definitely bent, but it did not break. And this table just illustrates that dynamic perfectly. That break of the 1920 level was almost certainly a cascade of automated sell orders, stop losses, getting triggered in that thin, bumperless market. But once those technical sellers were all flushed out, buyers stepped right back in at that more significant long-term support. The bigger structure is still totally intact. Now, let's take a look at Bitcoin. It also had a sharp drop, for sure, but context is everything here. That whole move was contained entirely within its well-established sideways trading range. So this looks a lot more like some violent chop inside a consolidation phase than it does the beginning of a new crash. And it's just like what we saw with the S&P. That break of the 94,000 level looks like a classic stop run, where the market just dips down really quick to trigger all those automated sell orders we talked about. And with so many people already positioned long in the market, it really doesn't take much to cause a quick plunge when there's no liquidity. It's basically a clean out, not some fundamental shift in direction. And what do you know? In the US dollar, the exact same story plays out. It broke one support level, which caused a quick flush, only to find solid ground and a bunch of buyers at the next major level, the lower bound of its own channel. I mean, the pattern here is remarkably consistent across the board. Now, the one asset that didn't follow this script was gold, but its action actually supports our whole theory. As a traditional safe haven, it caught a bid on all the uncertainty and just continued its existing uptrend. And what's really important is that it wasn't some panicked spike higher. It was an orderly continuation of its trend, just moving steadily toward the top of its channel. Okay, so the technical picture is screaming that this drop is just short-term noise. But for any trend to really hold, it needs a stable foundation, right? And that's why we need to zoom out for a second and look at the macro picture. There's a really fascinating theory out there that suggests the world is actually far more stable than it seems, and that could be providing a powerful tailwind for the markets. To get our heads around this, we've got to go all the way back to ancient Greece. In Plato's Republic, there's this character, Thrasymachus, and he makes this really cynical but powerful argument. He says that justice and world order aren't about high-minded ideals. Nope, they're about whatever serves the interests of the most powerful players. And that idea might be more relevant today than ever before. So what this theory suggests is that we might be watching a quiet grand bargain unfold between the world's superpowers. They aren't fighting for a new world order. They're basically agreeing to carve up the world to secure their own core interests. The US gets its strategic assets and gets rid of some irritants, while China and Russia get to solidify their own regional spheres of influence. So why does any of this matter for your portfolio? Well, it matters a lot, because if the strongest powers in the world have decided it's in their best interest to cooperate and divide up the spoils instead of fighting over them, that dramatically reduces the risk of a huge market-crashing conflict. This kind of unspoken stability creates a deeply supportive foundation for financial assets to climb. All right, let's put all the pieces together. We've got the short-term technical glitch on one hand and this long-term geopolitical stability on the other. So what does this all mean for the market going forward? The conclusion here seems pretty clear. When you combine the temporary weakness from that options expiration with the underlying strength from this potential grand bargain, well, the path of least resistance for the markets just stays higher. This really suggests that sharp drops, like the one we just saw, are much more likely to be buying opportunities than they are the start of a bear market.
Now, that's our base case, and it's built on all the data we can see. But what about the stuff we can't see? A big part of financial analysis is stress testing your ideas against the truly unexpected. So for our final point, let's have a little fun and consider a fascinating black swan scenario that could change literally everything.
And no, this isn't just me watching sci-fi movies. An analyst at the Bank of England actually explored this very question as part of a real scenario planning exercise. What would happen to our markets if it was officially announced that we are not alone in the universe? The theoretical reactions are just wild. Bitcoin might actually rise because it's seen as a truly global, non-terrestrial asset. But gold and silver, they could totally collapse if some advanced alien technology could just create precious metals out of thin air or mine asteroids easily. And the S&P 500 would almost certainly fall amidst just massive societal and technological disruption. It's a crazy thought, but it's a powerful reminder that while we analyze trends and technicals all day long, the most impactful events are usually the ones we never, ever see coming. It kind of makes you wonder, what's the next black swan that's going to change all the rules?